Well, I am excited. You guys know I get pretty jazzed up about this because we get to talk markets. You guys got to eat chocolate cake. It's another day in God's grace. Jake set up the camera to allow me lots of room to walk around, which is the way I like to talk, so that's good. Except for the invisible fence they've got with the feedback. But I am excited for these individuals that are part of the adaptive team. If you're not familiar with Client First, we run our business model basically after a family office. So family office is a term used in the industry for billionaire families. They have their own CPA, their own CFP, their own attorneys. They build a team of experts around billionaire families. We're democratizing that process. That's a fancy way of saying we're trying to do this for everyday Americans like you and me. On the adaptive team are these individuals here, in addition to our intern Pratty. I'll point out two very important things on this slide. One, it's not to scale. I don't want you to be scared when Dan comes up. He's not twice as big as everybody. Okay. Two, when Kevin comes up, you need to give him a big round of applause because he just achieved his Chartered Market Technician designation. So when he comes up, give him a big round of applause. It'll be a big deal. But we have a big agenda. The reason why we're jumping right into this is we have 100 slides. So normally, Paul, Justin, or someone from a different team comes up and we do like a trivia thing. What I'm going to do with the trivia is point you back to the expertise that's about to be in front of you. There's 8 billion people in the world. About 5 billion of them are working age. Only 4,500 people have the Chartered Market Technician designation, which means you're an expert at studying supply and demand in markets in risk management and portfolio settings. Our agenda is full. I always have to remind people, it's an education presentation. This isn't investment advice. We're all adults here. Some of you are our clients. You understand these things. If you're not a client, you can schedule an initial consultation with us, and we can go some of these things in more detail. But our agenda is jam-packed. Ian's going to come up and talk about 2022, which was a historically significant year from a volatility and correction standpoint. One of the biggest corrections we've seen on record across all asset classes. He's also going to talk about the average retail investor experience. The reason why this is important is if you're a client with us, sometimes it's hard to see what's happening on the outside compared to what's happening here. That'll be important to cover. Then we'll have Kevin come up. He'll talk about seasonality and the 60-40 portfolio. 60% stocks, 40% bonds. Dan will then come up, talk about volatility, the dollar, international equities, and value stocks. Then I'll rejoin you, and we're going to talk about our game plan for 2023. It's my wager that you don't find other investment advisors that do presentations like this. Very transparent, very action-oriented, and it's not about making predictions. Like, I don't have a prediction on where 2023 is going to end. If you want that, you can go to CNBC. They've got plenty of those guys. Okay, but if you want someone who has a plan on what they're going to do under different market scenarios, whether higher or lower, this would be a good place to start. Then, if we have time, we're going to have a Q&A panel discussion. Also, a kind of a housekeeping item up front. Believe it or not, while we love talking markets, we actually have to do our jobs. And so as soon as the presentation is done, this group is bolting out of here, so we won't have much time for one-on-one Q&A, which bums us out, but it's more important to manage risk for our clients in the office than it is just to talk about markets. So just a heads up on that, and then we'll go through housekeeping and final thoughts. So first up, Ian McMillan. Like I said, Chartered Market Technician. His opinion is valued is nationally. He's on Charles Payne Making Money on Fox Business frequently. He is also a proctor and someone who tests or examines tests for the CMT3. So level 3 is the hardest test. It's a written exam. Ian's actually part of the committee that helps grade that. He's also written a book for little kids called What is a Stock? So please give a round warm welcome to Ian McMillan.
Yes, all right, perfect. Thank you for that wonderful introduction, David. So as Dave said, we're going to talk a little bit about what went on in 2022. And while there was a lot to cover, We have a lot of slides to go through, so please do not take my speed as anything other than just trying to make sure everyone has their time today. But we will try to get into a little bit of detail where we can. So, again, 2022 year in review. This is just a kind of a general idea of 3 asset classes and how they continue to perform throughout a business cycle. So on the top here we have expansion, below contraction. I'm going to go ahead and put 2020 here in stage 4, 2021 here in stage 5, and the later half, majority of 2022 in stage 6. So we haven't really seen this happen. We still have stocks, bonds, commodities going down. Still no real interest in bonds from buyers. So we are going to, golly, that's bad. We're going to put the end of 2022 and 2022 as a whole kind of in this stage 6 category. A rough year for stocks and bonds. I think we're all pretty aware of that over here. 2022, quite the outlier. We've got T-bills down a little less than 20, stocks down about 20. By far the worst year combined for these two. Again, here's another little look at it on a timeline basis. And clearly the worst year for treasuries we've ever seen. And stocks, their worst year since 2008. So not a lot of places to hide between your 2 largest asset classes, fixed income and equities. Another way to look at this, how much collective money was lost last year? A 1-year drawdown of the total market cap of these 2 assets, U.S. equities and U.S. treasuries, as a percent of GDP. And again, worst since 2008, coming in around 55-ish%. So very, very tough year. Lots of money wiped out in U.S. assets. U.S. Aggregate Bond Index, this is just a great way of saying this is your average bonds. Kind of, we'll call it like the S&P for the fixed income. You got corporates, municipals, high yield, all of that type of stuff in here. It's just what did the average bond in the U.S. do? Over here we talked about treasuries, but this is talking about, again, by far one of the worst years, not one of the worst, the worst year for your average bond. Equities, we had two sectors that finished positive for the year. You had utilities, which in Q4 eked out a little bit of a year-to-date gain, 2.5%. And then, of course, you had energy up 55% last year. All 9 other sectors negative for 2022. Asset class returns. Another great way to look at this. Not a lot of places to hide outside of, yes, we had commodities. They worked for the first half of last year. They were positive. I wouldn't necessarily put them in a bullish uptrend per se. Cash, it's nice that cash now yields something. And then you had MLPs, which is an example of this energy strength that we saw, limited partnerships, everything else from U.S. bonds, U.S. high yield, developed ex-U.S., you name it, down anywhere from 10 to 30% on the year. So let's look at the average NASDAQ composite drawdown for 2022. So we had almost 50% of members had a 45% drawdown. Almost 75% of members had at least a 20% drawdown, and about 5% of members in this composite had over a 90% drawdown in 2022. So a lot of damage done out there, especially in the NASDAQ composite, which for the most part, kind of resembles your more techier, growthier stocks. And we know back on here on this page, tech down here, discretionary, all those, communication services, all those types of stocks getting hit the worst last year. Micro caps, average drawdown at its peak was 52%, end of the year at 46%. The average retail investor saw a drawdown of 35% last year. So by far the worst year that we've seen in retail accounts through this bull market that we've been in since 2013. So why do we talk about these numbers? Because it takes so much after a loss to recoup and get back to even. Having a 25% loss, we know, right, basic math, you don't just replace that with a 25% gain. You have a 25% loss, it's going to take you 33% to get back there. A 20% loss gets you 25, or it takes 25% to get back. A 50% loss, going forward, you have to double your money to get back to even. So when we talk about these 50% drawdowns over here, and over the last 2 years we saw, those stocks will now have to double just to get back to where they were. And that is a lot. That does not happen overnight. We talk also a lot about how bullish how bullish retail investors had been last year, but really we see that there was not a lot of selling in these types of accounts. A lot of individual households still held and are holding a lot of stocks even after last year. There seems to be a pretty firm belief after what we've gone through the last 10 to 12 years that the Fed will absolutely step in, and no one really wants to get caught selling again near the bottom. Everyone wants to ride this out and not get caught there like we did in 2018, 2020. So one of the things we always like to do in these presentations is to go through some of ourselves. So our team, there's always 4 outcomes with any possible trade. Our team has, we're okay with 3 of those outcomes. So the 4 outcomes being big wins, small losses, and big losses. We want to avoid that 4th, which is the big loss. And we do that, or can do that, by taking small losses. We rarely ever want to see a loss get too big. If we're wrong, much rather, accept it and move on to something else. So here's a few trades. We'll go over here. Here is Corteva. We bought this back in early October. Nice consolidation. In a healthy market, you would expect this to break higher. It did not. We broke down. So here we took the 2% loss. It's come back a little bit, but traded very poorly into the end of the year. So avoided larger losses on that. Here we have VET. Now, again, we are not a firm that goes into trades looking to be in them for 1 to 2 to 3 days. That's not our MO. But in this type of environment, if things just aren't feeling right, we absolutely will give ourselves the opportunity to get out. And so here's another example there. A few days, we're in this for 3 or 4 days. We sell out of it in September, and it continued to drift lower. So we took our little 4% gain. Is it ideal? Is it super sexy? No, it's not. But it works, and we're trying to find these small wins, right? That's the other number 1 or number 2 is small wins. Those are very, very acceptable. Everyone wants big wins. There weren't a lot of big wins out there to be found in 2022. So you got to find these small wins. Take them while you got them. Here we had United Health. Nice breakout. This is absolutely something that we would buy 10 out of 10 times. It did not immediately work. Bumbled around a bit and has continued to trade lower. That's really what this year was about. If it didn't immediately work, we were probably going to be done with it. and short China. So one of our better short trades from this year, up 7%. And since then, short China has been on quite the bullish run. So China's been up 32% since then. This is an inverse China. But again, just small wins, taking them where we can get them. So here's some data that Dan and Kevin have been working on this year. I think it's a great tool that can show, now right now we've just got cash, but they can put equities and fixed income on this. But this does show how our team throughout this year moved into, here we've got 100% cash right up here at 1.0. So these are our cash levels, and you can see this is not buying and holding. I mean, we are looking to raise cash. You know, here as markets got a little bit better, cash comes down. This is mid-August. Market starts to roll over. We immediately start bringing cash back up. We sit in very, very high levels of cash all through September, October, November, and recently have, you know, more in the 40 to 50% range of stocks. We're going to see if they bottom out here. But I think this is a great visual to look at how willing we are to raise cash when needed. Here's our fixed income exposure. Here's the growth model. So same, very high cash in these downtrends. This is back in March, April. Yes, we were in a downtrend, but in the overall context of the market, there really hadn't been much damage yet until you got into April and May. There's price history over to the left of this. If I showed you on a chart, we were still trying to work through. But April and May is when things really, as far as overall context of the market, started to look pretty rough. All right, so next we're going to have Kevin come up to present. As Dave mentioned, he is our newest CMT on the team. Super proud of him. He passed it last summer. There's a little bit more of a process and sponsorships that you have to go through. So I'm thankful that he's joining us today to share his insights. And maybe he'll give you a few tips on house renovation, because that's been something that him and his wife have been working very hard on of their own the last few months. So give him a warm applause.
Well, if you want home renovation advice, I'll give you this. If you want some high-quality work done, do not come to me or my wife. I'll tell you that. It's definitely been an interesting experience. Ever since we've been married, we've been working on the house, so it's been fun, for the most part. So far, nothing's burned down or fallen off yet. I guess the day's not over. So now, kind of that Ian covered, kind of last year in review, what we're going to kind of start doing is, what about 2023? What about looking ahead? So what I'm going to kind of cover here at the beginning is something that we, especially this time of year, really try to cover, and that's seasonality. So I'm sure those of you that have heard us present before have kind of seen these different time periods that we like to cover. And the first one is the Santa Claus rally. So what that is if you take the last 5 trading days of December and also the first 2 trading days of January, you take that performance of the S&P and kind of look at that as a gauge from your head. So on average, you usually see generally pretty positive returns over that year, which is great. But really, when we look at this time period, we're really not worried about necessarily positive returns. Actually, what we're more looking for, curious of, is when we see negative returns. And that's this quote here at the bottom of the page by Yale Hirsch: "If Santa should fail to call, bears may come to Broadwell." So really what you're looking for is any time where there's negative performance during this time period. And what we've seen this year, or actually I should say, if you look back at this over time, Yale Hirsch, McMillan, Stock Traders Almanac, they looked at 6 occasions where you did not see positive performance or market rally during this time. Of those times following, you saw 2 or 3 bear markets, another 3 flat or sideways markets. So really when you see negative performance during that time period, it kind of shows a warning sign for times ahead. So this year, good news, it's been positive so far. So I guess as far as predictive value, if you want to call it that, not necessarily anything to go on yet, but at least it hasn't been negative. So then we kind of like to look at what we call the power of January. So there's really kind of two breakdowns here in January. The first one is the first 5 trading days of January, which is pretty self-explanatory there. So the first 5 days in January, over the past 37 out of 44 years, when those first 5 days are up, you generally see a positive end of the year in the S&P 500, and it's even to the tune of 15% performance, which is pretty good. So kind of like the Santa Claus rally, the opposite side of this coin. So for these first 5 days, if you see negative performance, it's not as reliable. Really, it kind of comes down to performance after that is essentially a coin flip, so really nothing to look at there. And currently for this year, we saw a positive almost 1.4% for that time period, so also good, or at least showing good signs. After the first 5 days, really the next thing we look at is the entire month of January as a whole. So really they call this the January barometer. So what we're looking for here, which is really interesting to think about it, going back to 1950, every down month of January, with one exception, 2016, which oddly enough is the year I started at Client First, so it's interesting personally. It's probably my fault. We either had a flat market, a 10% correction, or an extended bear market. So it's really interesting. And oddly enough, the performances for that average annual loss come out to be around 14%. So almost the opposite of the first 5 days of January. So far, for this, right, January is not over, but we are positive over that time period. So really when you take these three together, right, we kind of call this the trifecta. And kind of the same thing when you're betting on the ponies, right? Obviously, you hit all three of these marks, it's a good thing. So since 1950, when all three of these time periods have been positive, and this is actually kind of an insane stat, 93% of the time, you're seeing an average annual gain of almost 18%, excuse me, which is crazy to think about. So if we were going to close the market today, all three of these would have shown positively. Obviously, there's still plenty of time left in January. A lot can happen in about a week, right? So I guess we're not totally sure how this is going to look, but so far so good. Now, another thing we often talk about, we talked about this last year quite a bit too for seasonality, is when we get around election years. So as I'm sure most of you are aware from all the commercials last year, we had midterm elections. And the exciting is that time period is kind of what does that mean going forward post-midterm election. We're also going to talk about how that deals with kind of pre-presidential election. So if you're not aware, the election results, midterms, Senate, nothing really changed hands there, but the House did transfer over to the Republican Party, which in this case the party really doesn't matter. What we're kind of just looking at is the fact that the House changed hands. So actually, our capital group here put together this nice chart that shows you kind of these 3 years, so 2010, 2006, and 94. Kind of when the House majority switched, and you can see that the election time is shaded in gray. From that point on, it just charts the performance of kind of what we saw in the market as a whole. And actually, it kind of really mirrors at least what we've seen so far quite well. So if you look at this, kind of immediately following the election, kind of mixed results, a little shaky, which I guess was what we saw last year. But then kind of as you look forward into the first quarter of the year following and beyond, it actually shows pretty good performance, which lines up with what we've seen so far in January and the Santa Claus rally. And this looks at more just general midterm election data, which essentially what this shows, if you boil it down, is the time leading up to midterm elections. You usually see underperformance in the market, and actually coming out of those time frames, you see more outperformance, which again is just another feather in the cap of what we're seeing so far. And since we've talked about January, there's been some good research out there that actually shows January, at least performance just for the sake of January, is actually better in a pre-presidential election year like we're in now. That's when January performance is the strongest. It's kind of another interesting season performance there. Just for reference, if you look at the full election cycle here, All-Star Charts put this together. It's a really cool graphic. You can kind of see the transition that we've just gone through post-midterm cycle, and now we're in the pre-election cycle. You can see kind of signs of historically strong seasonal performance from there. So I guess big question, right? What does that mean? It sounds cool. I think the thing that I'll leave you with here, which actually this morning, I'm not even sure why I thought of this, but if you've ever seen the movie The Big Short, there's a really cool quote on there right at the beginning of the movie. And I apologize in advance to the English teachers in the room. It ain't what you don't know that gets you in trouble. It's what you know for sure that just ain't so. So that's very true in a lot of things, actually, not just markets. If you want to talk renovations, I'm finding that out too. But that's the thing, when you talk seasonality, what is that? You're really talking percentages and probabilities, right? I mean, really everything we're kind of seeing so far will lead you to believe that it would almost be hard for the market to underperform this year, right? Everything is kind of checking those boxes, but really what we're doing a really good job of here is staying open-minded, right? When you talk adaptive, we're always willing to adapt. It's kind of those things that you think cannot have a different outcome that really get in trouble, right? So really probabilities look good for positive performance here, but that's why we kind of stick to price and really just focus on kind of what we control, what we know is fact, and then go from there. And just as a reminder, because I know once we start talking about political elections and things like that, coming up to the presidential election, not one single party really has any monopoly over investment performance. It's incredibly even historically. So just a little reminder there. So transitioning out of seasonality, if you were here when I presented last time, what I talked about was the 60-40 portfolio. So like Dave talked about, 60% stocks, 40% bonds. And I know Ian kind of touched on this too, just really a historical year for that portfolio, just bonds in general. Right around the time that we presented back in October, these were some of the news headlines that were out there. Is the 60 portfolio dead? And that sums it up pretty well from there. But interestingly enough, since then, well, here, I'll show you actually a chart. This was kind of at that time in October what we were looking at. So you're seeing drawdowns anywhere from 30 to 50 to 20% in that area, which is really unheard of for, as this chart shows, in the past 100 years. Oddly enough, since that point, we've actually kind of seen a resurgence in bonds. They didn't finish last year positive, but they started to plow their way back. We're going to get into that a little more in the Q&A, hopefully if we have time, so hopefully I don't leave you hanging here. But at least to kind of tie up that end of what we were talking about on October, they're at least starting to show a little bit of life. So I don't think yet 60-40 is dead, but I guess you never know. So with that, I'm going to transition over to Dan Gorghuber, who has been, oddly enough, a CMT for about 6 years now, I believe. So about as long as I've been a working adult. So he's got a lot more experience than me. And not only that, he has now 3 months experience as being a father. So it's a big development there. So we give Dan a warm welcome.
Side note on that fatherly thing, I think I'm averaging about 5 hours of sleep. Does that ring a bell for anybody here? No, it's awesome. I absolutely love it. I wouldn't change it for the world. So what I'm going to discuss here today is volatility in the markets. I'm going to hit on international equities and just some of the findings that we're looking at there with respect to trends and what our portfolios might look like. And then I'll kind of wrap it up with a little bit of a dissection of value growth and some of those terms, what they might mean for us, what they might mean for the industry as a whole. Okay. So this first slide, again, volatility. Who here, when you hear the term volatility, okay, you kind of have a negative connotation to that. So that kind of, raise your hand if you kind of have that negative connotation, right? I'm kind of a glass half full type of individual, okay? Maybe that's just like a Midwestern type of thing that you can relate with. But volatility, in a nutshell, does create opportunity for us specifically in the markets, okay? So with this first slide is kind of representing, we saw from the volatility perspective, okay, in 2022, 65 days, okay, so that's, when I did the math, there's 252 trading days in 1 year. 65 of those days were down 1% or greater. Okay, so that's just over 25% of those days. All right. We can look back through history, okay, since 1993, which, based on the VIX, our volatility index and our measure, that's when it was created. 2008 and 2002 were the only 2 times greater where we saw greater occurrences, okay, from this volatility measure in terms of greater than 1% move to the downside, okay? This is not tracking moves to the upside, okay? There is a little bit of a nuance there. Now, that kind of gives a picture for 2022. We've been talking about 2022 for the last half hour here. That kind of gives you some volatility summary of that. Now, the next couple of slides, we're going to get into the VIX index itself and kind of break that VIX index down. So that VIX index that we're discussing about, or I'm talking about here now, is it's taking the Chicago Board Options Exchange, okay, and we're measuring the options volatility on the S&P 500. Okay, so the S&P 500, we're all familiar with that index. And we pump out this VIX index. Okay, and this date, or this chart, is going throughout 2022. Okay, and you can see that we've had some upside, some downside, but for the most part, what I want to highlight from this chart is the sideways kind of consolidation that we've seen in this VIX index itself. Okay, it's ranged from 20 to 35, which on its own is an elevated level of volatility, right? Judging by that previous slide, we've seen that elevated volatility. But from a volatility with inside of this VIX index, we'll go to this next slide to say volatility within the VIX is actually trended downwards. Okay, so what does this mean for you guys, for myself? Why am I even talking about this? This downward rate of trend in this VVIX, okay, is basically suggesting compression within this VIX index. So volatility of VIX is in a downtrend, and that equates to compression or consolidation from what we had on this previous slide. Okay. So what can that tell us? It can tell us a couple of things, right? It can say, hey, we need to gear up for a bigger move in volatility, okay? Or it can tell us that, hey, maybe the VIX itself is just simply losing that steam that we once had, okay? When we look back to 2018, 2020, we saw volatility spikes over 40 in that measure, okay? We haven't seen that for a couple years now, okay? So we need to kind of prepare ourselves for certain environments off of that. Now, another section we want to cover quickly here is more of our dollar index weighting, okay? And this is going to be more of a look through how does it affect kind of the international space, okay? Our US dollar currency is, and has been for many, many years now, more looked at as a safe haven during times of volatility, okay? And we've definitely seen that over the last couple of years, 2021, 2022, right? We've seen a strengthening of our US dollar relative to other currency baskets, okay? And we're actually coming into some pretty interesting support from a technical perspective in our United States dollar from that perspective. So if you want to get into some of the weightings of that dollar index, I have it on the slide there for you, down on the bottom right. But for the sake of this, for the sake of these couple slides, I kind of want to get into this international equity space. and just cover upon the dollar index breakout last spring, okay, from a long-term base that we've had for many, many years. That is what this chart is dating, okay? So we have, on this chart, we have the Dixie return, so the dollar index return, as well as VEU return, okay? And VEU is an ETF. It's a Vanguard International Equity ETF, ex-United States, okay? So all things international, for the sake of the argument, is being placed on that chart with that line chart. We are seeing, really at the end of the day, a solid return from international equity space as of late. Okay, you'll notice the dollar index and the international equities tend to move inversely correlated. The magnitude of those moves is not necessarily 1-to-1 ratio, but generally speaking, if the dollar, our United States dollar, is going to be moving down on a day or a particular day, we tend to see international equities go higher, right, and vice versa. This is going to give us more of a relative strength picture of this international equity space from the October low, okay? The October low that we would consider more of an intermediate term low in the S&P 500 currently. All of these ETFs from an international perspective have been outperforming the S&P 500 again since that October low, okay? That's really the big slide, or the big directive point I want to highlight there. Now, that chart's great. Here are some numbers to put behind it, okay? We're seeing Italy, Germany, Netherlands, really lead this international space much, again, from that October low. And again, it's all compared to in relative versus the S&P 500 that we track here domestically, okay? Now you might be asking, okay, Dan, like, great, this is cool. International has been doing extremely well based on the charts here the last couple of months. Why haven't I seen that, or why are we not leveraged to the hills in the international space? Okay. Well, this next slide is going to give you that answer to that question on why we might not see that, at least yet. Okay. And that's because that VEU, that international equity space, although we've seen a big run-up since that October low, this chart is going back over 10 years now. We've had a downtrend versus the S&P 500, international versus the S&P 500, a downtrend over 10 years in running. And we're just coming back on an inflection point of that downtrend right now. Okay, we've seen multiple times in the past, as you see, where we have counter-trend rallies, okay, 2012, 16 to 18, 2020, where we see counter-trend rallies into that downtrend, that 10-year downtrend line. We're currently seeing that right now. TBD on whether or not we break through this rate of trend, okay? And if we are going to break through this rate of trend, our adaptive team is going to be on top of that, okay? And we're going to probably shift more towards looking at that international space from a long-term uptrend perspective versus S&P 500. Okay, is that going to make sense? I'll kind of try to wrap up here with this return to value and growth analysis. Okay, I have a couple minutes left. Really, the return to value argument at the end of the day, 2020, the March bottom in 2020 through August of 2021. We saw growth out of the bottom of that market. We saw growth really leading the charge, right? That's a healthy expectation to see from a market, is growth over value. Growth is outperforming that value counterpart. Okay, and specifically in the large cap space, which you'll see highlighted by the purple line. Now fast forward to Q4 2021, all the way to current day. Okay, that purple line is in a massive downtrend. That's large cap growth versus large cap value. There's been a complete shift over the last couple of years from those growth type equities to value. Okay, now that does not necessarily mean that value is positively returning. Okay, value could be returning negative numbers still. Okay, it just could be returning less than that of growth, and we'd still see that relative strength, right, out of out of the value space. For those that have sat in our educations before, this is a big component, Coke versus Pepsi, right? Relative strength on that. So that begs the question of know your indices, right? The S&P 500, the traditional sense of knowing your indice and your index from a growth versus value perspective. Okay, when you think of growth, what do you think of? Innovation, right? You think of technology, some sectors, healthcare, consumer discretionary, okay, some of those style companies and sectors. Value, you think of staples, utilities, materials, some of those financial companies that have been around for over 100 years, right? The interesting thing that I want to point out to you guys, and our team wants to point out to you guys, is that we've seen kind of a shift of classification over the last really the last year, but the implementation has been taking place over the last couple months, specifically on consumer staples and energy, okay? And this next slide really points out that shift. When we look at growth, the ETF, an S&P 500 growth ETF, okay, the ticker is SPYG. On the left-hand side, you'll see the sector breakdown and the weightings of those sectors for 2022. And again, I want to highlight the consumer staples and energy. Pretty low weights, right? Hardly 1% out of those sectors. Again, this is a growth ETF. You're going to see high weightings in technology, healthcare, consumer discretionary, right? Fast forward to current day, look at the consumer staples sector and the energy sector, and those increases in percentage changes year over year here. Energy is now almost 8.5% weighting in that growth ETF, and consumer staples is now almost 7% weighting in that ETF. Okay, so are we really, the question I kind of want to leave you with there is, are we really considering energy and consumer staples more of that growth style in the market, or is this just simply more of a rebalancing structure? There's some questions that we want to see answered from these indices and their allocations. Many of it, or much of it, can be exposed to just a simple momentum type cap-weighted style of measurement for these allocations. Okay, but it's something that we want to highlight. We want to know what we're investing in, right? We want to know what we're ultimately putting our money into. And growth, this growth ETF, has now seen higher allocations to energy and to consumer staples. Okay, so a fun little fact: many people in the markets might not even know this is occurring. But with that, I'm going to bring in our cleanup hitter, the one and only, actually. He's been around for 22 years in the markets. He's seen 7 bear markets. He's already been up here. And you guys obviously know his face. He is obviously the cleanup hitter for us. He's going to hit some home runs out of the park here. Can we get a round of applause for Dave?
Thanks, Dan. That was too nice. Fun fact is, I've only hit 1 home run in my life in real baseball. I was more of a doubles guy. I don't know how these guys accomplish the lack of feedback, but we're going to try. So you guys kind of drank out of a fire hose just now, and that's good and bad, but it's here to show there's a blessing when you watch these guys that are experts at what they do that maybe isn't being talked about in this moment. So some of you know I'm a follower of Jesus. I'm excited about that. I get to go to heaven when I die. That could happen tomorrow. You're in good hands. It's good to have duplicity. And so I hope you saw from Ian, Dan, and Kevin, it's duplicity. It's not just me. Same with the Trulistic team. It's not just Justin anymore. There's building a team around it so that we can take care of our clients. We're thinking long-term for our clients. Now, what I want to touch base on is revisiting some important points, right? Because you're drinking from a fire hose. I just want to leave you with some nuggets, right? When you get in the car, here are the things I'm taking home. And the fact is that 2022 was one of the most severe bear markets on multiple facets. Whether you're looking at stocks, underneath the surface that were anywhere between 30 to 50% corrections. Whether you're looking at bonds, which had their worst year ever recorded. And that's a new dynamic, right? The world has said you should own 60% stocks and 40% bonds, and you should buy and hold that, right? Most in the industry set their clients on that horse, slap its butt, and send it off into the sunset. So it's buy and hold. I call it buy and hold. And what I mean by that is, do you have a game plan, right? Because I don't know what the market's going to do by the end of 2023. On CNBC, they like to talk about these things. It makes people feel good, right? If you go to the doctor, and the doctor makes a prediction about your health 6 months from now, it makes you feel good if the prognosis is good. Rather than being real with you and saying, like, here's the game plan if this goes on, and here's the game plan if that goes on. We do the same thing when we consume news. We have a tendency to overweight the things that make us feel good. And there's not many years where pundits get on TV and say they expect a negative year. Most of them are always talking about a positive year. We've seen the data from Kevin. Seasonality-wise, it's possible that we see a positive year. We shouldn't discount that. Last year, the average retail investor was down minus 35%. You can see our model performances and their different aggressiveness and how they were affected in this market without much place to hide. In some instances, that drawdown was cut in half or more, depending on what model was used. Again, that's a conversation with an advisor from the Trulistic team, as far as if you have questions about which model you're in. When we look at the NASDAQ Composite and see how many members had a correction this last year, it was pretty significant. So again, 2022 was a place that you really couldn't hide. And really, if we examine what was going on underneath the surface, we've been most stocks have been correcting since the beginning of 2021, February of 2021. And I was in the airport the other day, and good old Jerome popped up, and I thought, wow, that's interesting. They have a playbook for the recession. It's almost guaranteed, right? And then let's be honest. If you could, give me an honest survey. How many of you think we're going to head into a recession? Be honest. Only 25%? I don't believe you. I think some of you are holding back. I'm just going to say it out loud. I'm not believing you because this is the topic du jour. This is what everybody's talking about, is that we're going to go into a recession. Now, the confusing part to me is, what's the definition of a recession? Most economists, I just use a swear word, forgive me, economists say that a recession is 2 quarters of negative GDP. You guys know we already had that, right? Okay, we just had some other people in other places, other houses that are white, say that it wasn't. So we've already had recessive numbers. And here we have a situation where post-midterm election year, hugely positive seasonality. We've already seen stocks correct anywhere from 20 to 50%. And now we're starting to see stocks compress. So, and that's my point on this slide here. I want to paint the picture, big picture. Yes, we are in a downtrend. That is not over with yet until we clear a 200-day moving average and break a downward rate of trend. So no doubt we're in a correction. But we're also in a compression. What I mean by that is since May, which is really the initial breakdown of this bear market, we've moved in a 17% range and prices started to compress. Think of it as a loaded spring. There's a larger move coming. And I know I was having a conversation with Diane over here, and she didn't say this was very comforting, but I'm going to say it anyway. She said, because I said from compression comes expansion, so there's a big move coming, I just don't know directionally which way. And I understand that that's not comforting, except for the fact, and I know you can, if you have an advisor outside a client first, you can ask them, what's your game plan for that? They don't have one, it's ride the horse into whatever sunset or storm that's ahead. For us, we have a game plan directionally for what takes place. That's it. Let's not overcomplicate things. From compression comes expansion. This is the Russell 2000. So 2000, much more domestic-based U.S. stocks, compressing since May. From that compression will come expansion. Again, I don't know which way. It's about having a game plan directionally, right? So IWM or small caps above 190, we like that. That means buyers are in control. More buyers than sellers, what does price do? Move up. Below about 165 on IWM, we want nothing to do with stocks. When there's more selling than buying, what does price do? Right? This is not, we don't need to overcomplicate life. Dow Jones Industrial Average, industrials have done pretty good recently, basically since the October low. We've got this level at 34,100. We want to see demand for stocks above that level. If not, warning label still out. This is the Value Line Geometric Index. It's not a very followed index. What it does is it aggregates a ton of stocks. I can't say all of them, but it's a lot of stocks. And it re-averages that index every single day to give it a more equal weighting. And what we've seen is this move sideways also since May. So this big range, we've seen Dan talk about volatility historically is high. But for 2022, it stayed high for a long time, so the volatility was flat. So there's a larger move upon us. So real simple, above 4180 on the S&P 500, we like stocks. If we're breaking back below 3780, not really interested. Don't need to be. We can continue to hold high levels of cash. NASDAQ 100, 12,100 is an important level. We want to see demand for tech and growth stocks. We'll see if that happens. Again, 34,100 on the Dow Jones. Emerging markets, as Dan was alluding to, we're starting to see a resurgence out of international. We haven't seen that for 2 decades. If you look back to the bull market out of the dot-com bust, so the 2000 to 2003, there was a correction in the market. Coming out of that, it was your value stocks and international stocks that led. We're okay with that if that takes place. We'll be positioned for it. 30-year Treasury yield. Whoever thought we'd be back up 3.4%. T-bills are actually paying more than this. If you're wondering how we're taking advantage of that, some of our models are holding high levels of T-bills. Super liquid market, good interest rates, and one of the things I'm excited about the most, potentially for the next 10 years, is if you think about bonds, since 1980 through now, it's been a 40-year era of rising bond prices and dropping yield that they're paying on those bonds. We finally could be returning to an era of, I have a choice. I'm either buying a treasury that's paying me 8%. If I buy a stock, it better pay me more than 8%. So the Warren Buffett hurdle rate is back, baby, and I like that. It's a good thing. So with us, we're always going to stay focused on the 3 main objectives: big wins, small losses, trying to avoid the big loss. Compression-wise, we'll see where the market, what it does, but earnings season is here, and most of the time, the estimates are wrong. And what we care about is the price reaction in earnings. Earnings can be whatever they want. It could be zero, it could be negative, it could be positive. I don't care. It's what the market thinks that I care about. It knows more than me, knows more than you, knows more than most investors. So with that, I'm going to bring up Ian, Kevin, and Dan. We've got about 5 minutes. We're going to ask them some questions. I've got a couple prepared. And then we will close up shop so you guys can get out into the sunshine. Looks like the sun's coming out. Pretty quick. Kevin, I'm going to start with you. At the last Lunch and Learn in October, we talked about things that in October, which we now know was an important low. We didn't know that at the time. Like, no one knows that in real time. But we were looking for some clues for what would lead us to believe that maybe the market could start moving higher? And one of those things was just maybe bonds could just stop going down. So what are we seeing out of bonds since October? Is that the case?
I would say short term at least, yes. So funny enough, I think it was 5 days after we presented, at least short term, that was about the bottom in bonds. So especially with me talking about the 60-40 portfolio back then, I called that one pretty good apparently. But yeah, I mean, since then, at least in kind of the last couple of weeks, couple of months, I've been seeing kind of a series of higher lows, higher highs, which by definition is kind of an uptrend starting there. I guess even more recently to kind of this last week or so, if you've listened to the podcast, there's still kind of some important levels that we really haven't gotten over. I guess you can be super excited about bonds, but at least kind of like what Dave said, at least they stopped for now going down. Which if you remember that chart that Ian had up before of the business cycle, kind of that first thing you want to see, at least as bonds participate, or at least not getting taken out behind the woodshed. So, so far so good for that, but time will tell.
Okay, no, that's fair. I mean, we've got a potentially seasonal tailwind. If we stop seeing bonds go down, that would be further evidence that maybe a new bull market leg is upon us. Could be, no idea. And I'm glad that you brought up the market cycle. That's an important aspect. Dan, how's it going with Catherine?
It's the best.
Catherine is his daughter, born in November.
Yes. Even with the lack of sleep, I absolutely love it. It's like I said, it's the best time of my life, I guess, right now. And, get up the worst day, but go and see her face at the end of the day, just smiling or whatever it might be. It's pretty priceless.
Awesome. Well, since you're the newest member of the team, that's your softball question. After this, it gets harder.
All right.
Ian, you noticed something today that we didn't have time to put it into the presentation, and it involved the Caterpillar stock. Can you kind of paint the picture for what's going on with Caterpillar stock? And so Caterpillar stock's going out at new highs, all-time highs. And so the question that you would ask yourself is how bad can things be if Caterpillar, one of the biggest industrial companies, is going out to new highs? What do you think, Ian?
So just one of the similarities we found is the exact same thing happened. So stocks peaked in October 2007, and Caterpillar, a year later was making all-time highs, and this is about March 2008. So again, kind of the same thing. Broad markets are going down. Here's this very important industrial company that seems to be holding together. You would think, why is a company with this much global exposure, why are they doing so well? Clearly, maybe the world's not doing so bad. And then Caterpillar ended up peaking, and it was kind of this false. It kind of gave a false sense of hope, I guess, to say. And here we are 14 years later, and people keep pointing to the exact same situation. And I don't think it's the most valid argument to make at the moment.
I agree. So, since we're up against our time, I'm going to ask one last question. It's an open question. Any of you guys can grab this one, and then we'll roll out of here. But if this bear market is going to end, what are some market characteristics that we're looking for that would signal, okay, we're coming out of the woods, this is starting to end? What would we be looking for?
Higher prices.
It's a good one. I would maybe add to that, just want to continue to see the dollar, our U.S. dollar, continue to kind of trail off. Because that's kind of been that safe haven for the last couple of years. And from a narrative context perspective, if we can see that shift, that might help.
Well, I kind of already said bonds before, but I guess one thing, and I know Dave mentioned right here, and Tierney's been doing a lot of work, and we've been a little bit as well too, is breadth. So if you think of that more as participation, we'd really want to see that start picking up, which I guess at least now we're seeing signs of participation increasing, which is good. But that's pretty recent development stuff in early.
Can I force you to dovetail on that? Can we talk about this breakaway momentum a little bit? Do you feel comfortable talking about this particular chart? And talking about, so breadth is not breath, like what comes out of my mouth, it's participation. Like if you watch a marathon race from above, it's very obvious to see when it's the end of the race, right? Because the runners are far apart, or whether the race is just starting because the runners are together. We may have just seen, I'm going to answer it, but perfect. We've just seen where we've had 10 days where on the NYSE 2-to-1, meaning 2 stocks advancing to 1 stock declining. That's expansion, right? We're seeing that happen on a 10-day basis. It's something called breakaway momentum. It has given false signals in the past, but it's one of the more reliable shotgun start launch of a new bull market leg. We'll see if that plays out. The last time we had something like this was right after the COVID crash. And then you can see the red dots where it's shown up before. Whether that plays out is TBD, but I think we have to keep an open mind on potential outcomes. So with that, we're up against time, so I want to leave you with some final notes. My basically final thoughts are, let's not overcomplicate things. This was a weather station on a vacation I went at. I loved it. Let's not make life hard. When Ian says we want to see higher prices, that's exactly right. Why would we not want to see higher prices for a bull market to continue? Let's not talk about Jerome and the Senate and the House. I mean, you can talk about that, but just don't do it around us, maybe. From this compression, we're going to see expansion. Directionally, I don't know which way. When I think about earnings season this January, there's a lot of companies, big companies, reporting on the same week. The next 3 weeks could be very, very telling directionally which way we go. Again, it's not about the earnings. It's about the price reaction to the earnings. And what's your game plan for it? Simply for us, if you're to remember a chart, S&P 500 above 4180, we're going to be more fully exposed. We're going to drive 70 miles an hour. The sun is out. We're going to put the cruise control on above that level. If we're below that, much more warning sign, holding high levels of cash. Because we want to stay in these 3 main objectives. Identify risk and reward, direction of the trend, big wins, small losses, trying to avoid that big loss. Final pieces, feedback. These guys, I thought, did a fantastic job, so if you could give them a round of applause, I would appreciate it. Don't be bad for you. Well done. This sheet is great for providing information and giving your concerns and next steps. There's a QR code that you can snap if you want to do it electronically. We have the Trualistic team in the back, along with our client experience team, if you want to talk to anybody about scheduling an appointment. Next month, Paul is presenting, our managing partner. He's going to be presenting on identity theft and consumer privacy. You don't want to miss that one. He always does a good job collecting information, and tax season is here. Everybody's favorite season. But I think what you'll find important is that there's not a lot of financial advisors that also do taxes. And it's your number one expense. So to me, not having an advisor that also does taxes doesn't make a lot of sense to me. Because otherwise there's just a lot of finger pointing between the advisor and the CPA. We do that in-house. It's a collaborative effort. It's that family office atmosphere that we're trying to build. Right? I don't like, this is where I go with taxes. But then I give them to Meredith's team and she makes me feel like this. Okay? And that's something that you should look forward to as well. Again, it's really simple. We make it really simple here. We're pretty low pressure. We're not asking you for your business today. It's really a 4-step process. If you're interested in further things that we can help you out with to secure your financial confidence, You schedule a no-fee initial consultation. After that consultation, if you're a right fit with us, you go through a process with the Trualistic team to have a customized financial plan done for you. After that, it's an ongoing process. Every year, we're readdressing, seeing what's changed in your life. It's a pretty fruitful process, especially when we're involving taxes. And then you enjoy your new financial confidence. So pretty simple 4-step process. Diane?
If we've already had our taxes done by clients first, and they've been e-filed, then we already have a PIN number.
Diane's question, which I actually don't know the answer to, so I'm going to be leaning on potentially Brad or Justin or Jake. I'm just peeking around for knowledge experts. Diane's question is, if we've already filed taxes with Client First in the past, we already have a PIN. Does that question sound familiar, or should Diane talk to one of you afterwards? Justin?
If you get a PIN from the IRS, normally it means that you will always get one because something was compromised potentially in the past. Once you get a PIN, you will always get a PIN in the future, and it's new every year. The IRS mails it to you. Don't lose it, because if you do lose it, you can get it, but it's a lot of work.
Diane, did you hear that?
Yeah, so it's not because we've already had the e-file?
Nope.
Okay, thank you.
All right. So with that, that concludes our presentation. This crew, we're heading out for our afternoon market call, but I really appreciate your time. Enjoy the rest of your afternoon.